Peng. I know. I talked to Peng. She goes to Palladium. She goes to Palladium. She came up to me after. She's like, "Oh, aren't you in that group?"
Yeah.
You want to just announce it? Just announce what you want to announce.
Okay. Good morning, everyone. Hi. John and I, we're working on the Stern Consulting Core. We're working for a project, on a project for a meat jerky company, and they're launching into the sticks business. So we would have a quick survey, which would be great if you could all fill it out. It only takes a minute. That's the QR code. If you have a laptop, you can also type it in. It's only 4 questions. I realize a bunch of you might have answered the survey in like another class, like advanced strategy or something. If you have, it doesn't matter because we're just going to use those numbers going forward because I need a larger sample set. Okay, thank you so much. That was it. John, you want to add something?
No, and if you guys want some samples afterwards, just come find me in the back doors.
Yes.
Okay. Not on? So you guys were cutting it close. I saw cases come in at 10:26, and I'll wager when I go back there's going to be a 10:29:55 case. And I'm not going to be a hard ass, so you send it in at 10:31, it's okay. You send it at 12 o'clock, you better come and talk to me directly because that's going to be an issue because you'll have to convince me that nothing happened between 10:30 and 12 to change the numbers on your case. So let's spend some time. You've been spending the last couple of weeks, you're sick of whole food, you're sick of restaurants, but I want to get it behind us before we move on. And I want to use this case to actually talk about things that are more general, because obviously the case is done. It's a sunk cost. So as you look at the numbers, I wish we'd done that. Don't let the small things get in the way. So I'll actually send you at noon, I'll send you a template on how the case is going to be graded, and essentially say these are the things I'm looking for. And most of you, there are like 10 things on that list. And if you get all 10 wrong, you get 0. But I'll wager that most of you got 8.5, maybe 9 out of the 10. And one thing you might have, so we'll talk about a couple of things that I think are common issues in these kinds of cases, but I'm going to use it to extrapolate to the rest of investment analysis. So first, I want to talk a little bit about time. What am I talking about? Notice how confusing your 0 and your 1 and your 2 can become. Because see, what exactly is year 0? Is it last year? And I think the problem comes from the fact that we wanted convenience in investment analysis. In the real world, when do cash flows come in? They come in across time. They're continuous, right? The problem is you don't want to be discounting cash flows on an hourly basis or a daily basis. So for convenience, we act like everything happens on the last day of the year. That's what happens when you discount cash flows back. Some people try to be extra clever and use midpoint conventions, but it's still a point in time. Cash flows occur across time. So when you talk about continuous time actually is difficult to deal with. So we deal with discrete time. So when you do valuation or investment analysis, you know what year 0 is? It's right now. This is when you're making the decision. Year 1 is, it's the next 365 days. It's not a fiscal year. It's not a calendar year. It's the next 365 days. And that's problematic because accountants don't think in that time, right? So if you sit down to value a company today, it's April 3rd, you want the next 365 days. You ask the accountant, give me the last 365 days. You're not going to get it. You might be getting it through March 30th if you have a first quarter ending there. Or if you're stuck with annual reports, December 31st. You can't change that, but you have to live in the world that exists today. Your decision can't be as of January 1st, 2019, because unless you built a time machine, you're where you are. So it's something that's always an issue. So if you struggle with it, it's because of this artificial 365 days forward. So when you look at year 1, year 2, year 3, the best way to think about them is not as 2020, 2021. It's the next 365 days. And if you labeled it as 2020, I'm not going to freak out. I'm just saying that that's not the way cash flows work. So let me give you the hammer first, and then we'll look at the nails. So this is a page you're going to freak out, because the number you will have will not be the number that I got. But to put your mind at rest, 55 of the groups did turn in their summary numbers. No two groups had the same number. So put that away, because and you're saying, but it was the same case, the same facts. That's the first thing to recognize, is you had to make some assumptions along the way. And unless and that's why I've never ruled out two people doing the same company. There is no way on God's good earth that even if you had all of the same financially mature company, you're ever going to get the same number. So here's what I found looking at the numbers. I looked at the return on capital, but I spent very little time on it. You know why? What is the end game in the case? I was asked, am I going to invest in this project? I knew I was going to base the investment on return on capital, so I could have spent half my time talking about accounting allocation, and the question is why? If I were basing my decision on return on capital, I'd be spending on, should I use incremental earnings, should I use average capital? So no matter how you slice it, the project does not look good if I just look at the return on capital for just the restaurants. It's about 6.38%. It does look better if I bring in those side benefits from the prepared foods. It makes the return on capital look better. And you're going to see that pattern play out in all my conclusions. When I computed the net present value with the finite life, the 15-year life, the net present value that I got, that doesn't look right? Is it? Did I pull up the best? No, it actually is minus 109 million without the side benefits written. It's negative. But when you bring in the side benefits, the net present value becomes plus 82 million. When I looked at the infinite life, in fact, did I ask you to do an infinite life or just a longer life? Hey, that's the other thing. Notice all of us went to perpetuities. Why? Again, because it's convenient. You could have used a 15-year life after year 10. It's a longer life. But as we said, as you extend the life out, with the perpetual life case, I got minus 78 million as the net present value. And if I bring in the side benefits, it goes to 284 million. Take a look at that difference I get in net present value. It's about 200 million. One of the things I'm going to put up is a distribution of what you found when you went from the finite to the longer life case. And many of you saw a much bigger jump in your net present values. And one of the things I'm going to focus on is why that tends to happen in investment analysis when you extend the life out. In my case, the effect was relatively small, but the conclusions don't change. Negative if you look at it as a standalone project, but with the side benefits built in, it's positive. Same thing's true for the IRR. If I focus just on the cash flows from dining, I get an IRR of less than 5%. If I bring in the side benefit, it jumps to 9.27%. My cost of capital for Whole Foods dining is 8.53%. Okay? And I'll back it up on the next page. If I were to summarize my findings on this project, it is a blah project. Basically, even with the benefits, I'm dancing on the head of a pin. I'm going to earn just above the cost of capital. Should I take it? If this had been Whole Foods standing alone 4 years later, my suggestion would have been, hey, don't tie up your resources in restaurants. Somebody's going to come after you, probably Amazon. So you got to have your powder ready, so this might not be where you want to do it. I think the fact that this is now part of Amazon, and Amazon takes zero net present value projects all the time. I don't know what the end game is, but it's world domination, I would guess. Okay? And you got to get people eating at restaurants. My guess is because Amazon is the driver, and you can see how decisions can be shifted depending on who's got the cash, who's got the capital, how capital. There is no capital rationing constraint at Amazon. So I would say take the project, but be realistic about it. This is not going to make or break the world. This is not going to make you into a great company. It's just one more piece of a larger strategy. But overall, nothing in these numbers say incredible project or horrible project. So let me do the first thing, is coming up with the cost of capital. There are actually 3 different costs of capital that are floating around in this analysis. I did 2 of them, but some of you might have done all 3. The first was the cost of capital for the restaurant business. And I kind of gave away the game, right, on Monday. As I was saying this, saying, I'm giving away too much. But let's face it, I can't stop talking, because what did we say on Monday? We talked about how when you look at a project, you should look at the cost of capital for the project. Remember Bookscape? I kind of gave away the entire landscape. You're looking at an online, retail investment. You can't just take your existing cost of capital. So for the cost of capital for Whole Foods Dining, I started with the unlevered beta for the restaurant business. I thought about letting you go collect that data, but I was terrified of what I would be grading then, because who knows what you'd hit and what you'd include. So I kind of constrained the game. But even with the constrained game, I gave you the peer group, right? You think we'd all agree on the unlevered beta. I was actually browsing through a few of your reports. I didn't grade them because I'll wait till 12 o'clock to start grading. I noticed that some people computed the unlevered beta by averaging the beta first and then unlevering. Other people unlevered each company's beta and took a median. And you get different answers. So in fact, you get a lower unlevered beta if you unlever each firm and have. Which one is right? It's not a financial question, it's a statistical question. I prefer to average first and then unlever. But if you unlever first and then average, hey, that's perfectly okay. But the range you get is you get a beta which is about 0.1 or lower if you unlever first and average. In my calculation, the unlevered beta that I got using I used actually the median numbers because the averages were thrown off in the debt to equity, was about 1.03. Now, there was actually some cash in these companies, so I cleaned up for the cash. Is everybody clear about why we clean up for cash? I know mathematically I do this all the time. No idea. Okay? And actually that's good, because I want this to be clear, because when you get on your job and you talk about cash, I want to. When I compute the median unlevered beta for restaurant companies, I'm getting an unlevered beta of 1.03. So that is the median unlevered beta for a restaurant company. But a typical restaurant company is 98.7% restaurants, 1.3% cash. I want an unlevered beta for just being in the restaurant business. So the reason you clean up for cash is to get to that 98.7%. Mathematically, all I do is take out the cash. Cash is a beta of 0. So when you clean up for cash, that's what it's called a pure play beta. You're trying to get a beta for being in the business. So by my calculations, that unlevered beta for being in the restaurant business was 1.04. If you got a different number, and you worked with the same peer group, it's either because you used the average, you're unlevered for, it's all perfect. You're at least working with the same process to come up with an unlevered beta. Then I applied the debt to equity ratio. And here I had to be a little specific, right? Because if I just not given you a choice, then you might have said it's a restaurant business. I'll use the typical debt to equity ratio for restaurant companies. The choices were endless, but I constrained your choice. I said, this project, Amazon is planning to use its existing debt to equity ratio to fund the project.
What would you typically use Amazon versus?
It depends on how.
Ratio was a lot higher.
Right. It depends on first. You know why it's higher for restaurant companies, right? Because they have to lease the land and build the restaurant. So in a sense, in this case, it's a gimme. It's a part of an existing lease. If you are given nothing, then you probably should at least look at the debt to equity ratio of the sector. The more independent and standalone a project is going to be, the more you should look at other companies in the sector. Because in a sense, I'm letting Amazon's debt ratio and cost of debt enter the cost of capital. I'm a little worried about subsidy, but it's a within company subsidy. So I'm less worried than I did in the acquisitions. So the 5.51% debt to equity ratio reflects their existing debt. Half of it is roughly from interest-bearing debt, and half of it comes from lease commitments. This was the only number where there was some convergence. I noticed the same, partly because all the numbers were given. The lease commitments were given, and the cost of debt was given. But it's about 5.5% debt, 94.5% equity. So basically, I have a levered beta 1.09. That gives me a cost of capital. A cost of equity of 8.81%, fed into a cost of capital, it's 8.53%. That was the cost of capital I used to discount my restaurant cash flows. You're saying, what are the cash flows are there? What are the other cash flows that are in this project? I got the prepared food cash flows, right? And again, if you decide to use the restaurant cost of capital to discount the prepared food, in this project it's not going to make or break, because the projects are not different enough to matter. But you can see why that's dangerous, right? If this had been a side benefit, which was much riskier, much safer than the rest, by using this 8.53% on it, I'd have gotten into trouble. Just to keep myself honest, I computed a cost of capital for the prepared food business. And I gave you the raw data for that, right? Because I thought about giving you another set of 35 companies, but what's the point? If you can do one, you can do the other. I gave you an unlevered beta for the prepared foods business of 0.90. That became my starting point for a levered beta and a cost of capital. So the rest of the inputs look pretty much the same debt to equity ratio, same cost of debt. I get a cost of capital of 7.28% for the prepared foods business. Is there a third cost of capital that could be floating around? There's a grocery beta that I didn't use because I made no assumptions. I did notice a couple of the groups I was looking at, in a sense, thought through this thing in the right way. I didn't think it's going to be an issue, but they said if you're going to take away 10% of the store space from the grocery stores, maybe the grocery stores will actually lose sales, and therefore there will be lost sales. So if you had a third ingredient in the cash flows, which I didn't, but if you did, you know what you need to compute? A third cost of capital, which would be the gross. You'd have three costs of capital floating around because you have three sets of cash flows. And each discount rate will have a place based on the cash flows I'm discounting. Any questions on the cost of capital computation? Okay. So with each one I'll stop and show you what you sent me. I will not be responsible. I have to put the disclaimer down. These are just your numbers. If you find a freaky number there, it's probably because you forgot to put a decimal point, and it's not my fault. Okay? So, and in the cost of capital, there were no freaky numbers. The median cost of capital you came up with across as a class was 8.38%. The peak of the, and this is just I asked for only one cost of capital. So some of you gave me the Whole Foods dining, some of you gave me a composite. So that partly explains the spread. There were a few below 7% cost of capital. And I'm curious. So I'll probably take a closer look at that cost of capital, because with the numbers, I can see 7.9%, I can see 8.6%, but if you get a 5.9% or a 6.5% cost of capital, my guess is that you either used a regression beta and you plugged it through, which after all, you can use it in your job, but don't use it with me because I don't like them. And also they don't make sense for this project. What's a regression beta for Amazon going to tell you about this project? What's a regression beta for Whole Foods set back 2 years going to tell you about the project? So if you get a really low cost of capital, again, this is not the death knell for your case. So, oh my God, everything's going to fall apart. We use the regression beta. Just live and learn. This project might cost you a point. It's only a point out of 10, but hopefully the remembrance, the pain that point lost will create will make you remember never to use a regression beta again. I can hope for good things. So that's the cost of capital divergence. Now I'm going to hit you with numbers. And this is where there was a lot of model building. Okay? I'm not a great believer in making you Excel ninjas. Okay? Because that's not a skill set that is you pay $200,000 for. If you're paying $200,000 for an MBA and what you get out of that is you become an Excel ninja, you paid way too much. But you need to at least be comfortable enough to make Excel your tool, not the other way around. So the nice thing about Excel is you can start building these things. And the only suggestion I would have in general with model building is never put hard numbers into cells. You live to regret it. Because you're in a hurry, you're saying, I don't feel like going in and I'll just put the margin in directly in there. You will regret it every single time. Even if it takes the extra 15 minutes, create an input page and make them up. This is what I got as my measure of operating income, and I was checking through your operating. Most of us get pretty much the same numbers, same number of revenues, same number, We'll talk a little bit about the expenses, but I did two measures of operating income. One was the way accountants think about things with the full allocated G&A. But we know that is going to get us into trouble when we get cash flow. So I did a second calculation because I do this because it makes my life easier, because I hate starting with operating income and trying to clean up for the mess. Because the 1 minus t, the t, what you add back, sooner or later you're going to screw up somewhere. So I also did an incremental operating income where I replaced the allocated G&A with the actual increase in G&A. So there's the operating income after taxes, the incremental operating income after taxes. And you can see you start with losses and then you build up to profits. But of course, standing alone, operating income doesn't tell me much about the project. So I took the operating income and converted into a return on capital. Just to give you a sense of how divergent numbers can be, I computed 4 returns on capital. 2, I just used the operating income from the restaurants, and I get much lower numbers. 2, I use the operating income with the side benefits built in, which I get much higher numbers. I also computed an operating return on capital using the accounting income and the incremental income. The results actually are pretty much consistent. Without counting the side benefits, I don't hit my cost of capital. When I count my side benefits, I get to a number that's in the double digit that hits my cost of capital. And when I look at the return on capital for across your cases, I expect to see wide differences because you have to make some accounting choices about how you depreciated things, and that can affect your operating income. What you counted as invested capital. I count working capital as part of my invested capital. Some people just look at the fixed assets. And the reason I'm not going to contest you on any of those is unless you based your decision on return on capital, it's just a kabuki dance. You do it, you show me the number, and then you move on. It's a kabuki dance you're asked to do on projects, but my point is your accounting choices will move your return on invested capital. So now let's get to what you found in return on capital. Your median return on capital was about 12%. And my guess is almost all your returns on capital you sent me included the side benefits, so it is pushed towards my number pretty close. Your average was about 11. The high number was 19%. And there was one group that did have a negative return on capital, which must mean you're losing money for a really long time, which means there must be an expense in there that's pushing your income down. So that was the outlier. So most of the returns were 10, 11, 12%. So now let's get to the interesting numbers. Because up till now it's accounting earnings, who cares? Now we're going to talk about the numbers that are actually going to drive my decision. So I got to wake up. I first looked at the finite life case. Many of you thought of these as scenarios, finite life or perpetual life. They're not scenarios, they're operating choices. You know what I mean by that? It's not like at the end of the 15th year, somebody tosses a coin. If it lands heads, the project ends. If it lands tails, you keep going. If you want to keep your project going after 15 years, you know when you have to start thinking about it? You've got to start thinking about it today. You'll see this play out in my assumption. So when I did my finite life case, I could keep things focused. I essentially had one cost I had to bring in, which my accountant had forgotten, which is if I build these restaurants, I'm going to run out of parking capacity. Now, when you run out of capacity, there are a couple of things you can do. One is you can turn people away. Parking is full. In which case, what's the cost you face? Those grocery shoppers who show up who can't park are not buying groceries, so it'd be lost sales. So I could have told you that after year 6, when you run out of capacity, there'll be lost sales. You'd have computed the cost by looking at the lost sales over the remaining 9 years of this project. And that's messy. So I made this, I think, as clean as I could, which is if you don't take this project, you have parking capacity, but you're going to run out of capacity still, right? It's going to be in year 12 rather than year 6. Think in time value terms. You're still spending money on capacity. The only effect this project has is you spend the money earlier rather than later. So from a present value standpoint, you know what effect it should have? It should be the difference between investing in year 6 and investing in year 12. Of course, there's all this depreciation stuff, but again, that's the core difference. So when you look at my numbers, I'm going to try to show you how I did this. There are a couple of ways you can do this. I'm going to show you one way to do it, but I'll also talk about a second way. But that's the cost of the project. In my finite life case, remember I'm running the project right from year 1 saying I'm going to wrap it up after 15 years. I'm not going to be loading up into capital maintenance and making things look great for the next 15 years to shut it down. So I'm going to have less capital maintenance in this scenario than in the next one. That's what I mean by an operating choice. You are running the project right from the beginning, recognizing it's a finite life project. You're going to run it differently. The working capital investments, I'm going to assume happen at the start of the year. This, I'm going to let you pass whatever you did. But when I say start of the year, what does that mean? That to get my year one revenues, I need to invest in working capital now. What's now? 0. So in my analysis, you're going to see a working capital investment at time 0. Why? Because I need to do that inventory before I open the restaurants. So if you put your working capital in year one, you missed a year because your working capital will predate your revenues. So you're going to see my numbers reflected. So let me focus on the numbers where you probably have different numbers than me. I actually put no capital maintenance. I went in, it's probably an extreme assumption. I basically said no capital maintenance. I build the restaurants. They come online. I'm going to run them for 15 years, and then I'm going to shut them down. If you look at year 0, you have a $7.5 million working capital. Remember, I gave you accounts receivable, inventory, and accounts payable. Your working capital is accounts receivable plus inventory minus accounts payable. I did notice already on one case, you'd added all three numbers up. Working capital, you net out accounts payable because it reduces your working capital need. And every year after that, how does working capital affect my cash flows? It's only changes in working capital that affect my cash flows. So every year after that, I count the changes. Until I get to year 15 and you see this big negative number, minus 32.99. What am I doing at the end of the 15th year? I'm shutting the store down. What do I do with all my inventory and my shelves? I don't throw it in the trash can. I have a going out of business sale, a real going out of business sale, not a New York City going out of business sale. And when I have a going out of business sale, what happens? I liquidate my working capital. I get all of it back. That sounds extreme, but remember, working capital is recorded at cost. You know what the margins are for grocery stores and prepared food and stuff? If I sell it at cost, I can knock off the price 70%. It's on sale, but I still get my cost back. So at the end of the 15th year, I collect my inventory back. When you do finite life cases, you can't leave loose ends out there. You can't just get to the end of year 15, shut the doors and walk away because there's stuff in the store. Here's the second thing, minus 169 million in year 6. That is my parking capacity being built in year 6. And because it is a capital expenditure, I depreciate it. Using what? Remember I suggested when nothing's given, just do straight line depreciation. But rather than add it on to my total depreciation, which creates a circular reasoning mix because you then have this depreciation that's on top of capex and top of depreciation, I just took that depreciation and looked at the effect it would have on my cash flows. What's the effect depreciation has? It reduces taxes. So I just took the tax benefit from the depreciation. That's my cash flow effect. Why go through the hassle of adding depreciation back and subtracting depreciation when that's what's going to be left over? So here's what happens. Because I'm building the restaurants, I run at capacity earlier, I spend 169 million, I start collecting depreciation, I get tax benefits. But when you get to year 12, notice there's a minus 190 million. What is that? By taking this project, everything is incremental. By taking this project, I have to spend 169, but by taking this project, I save myself that investment I'd have had to make in year 12. What happens is in my cash flows, here's what's going to happen. The effect of this parking is going to show up as the difference in present values between investing 169 in year 6 and 190 in year 12. That present value difference is probably going to be about 25 million. That's what my net present value is being moved by. So here's the other way you could have done the parking. You might have said, look, it's too messy to put into my cash flows. I'm just going to take the present value difference between investing in year 6 and year 12, add it to your initial investment and say, I'm done. You should get exactly the same answer because mechanically we're doing the same things. There are lots of different pathways for doing this, but all of them require that you bring the other half of the equation. You know what I mean by that? I will wager in 80% of the cases, I will see minus 169 million. In fact, as I looked at every case I looked at had the minus 169 in year 6. But half of them, basically that's all there was. So you made the investment, but you're not bringing in what you potentially benefit by investing earlier, which you don't have to do the year 12. So this just makes sure that I'm keeping things on an incremental basis. Any questions? Yes?
Professor, I have a question about the parking investment.
Yeah.
Since all the parking capacity will be only used for the dining business, which means the grocery also will use.
So if you're an accountant, did everybody get the question? The parking capacity, it's not like there are parking spots for restaurants. You could potentially do it, but that's really inefficient. You're going to have parking spots, restaurant people can park in them, and grocery store shoppers. So if you're an accountant, what do? You allocate. So that's why I said your return on capital can reflect that choice. You could have said, I'm allocating 23% of the part. You can do whatever you want in accounting, but look at the effect on your cash flows. I don't care who's benefiting. What's the effect on your cash flows? You have to spend $169 million. Who it goes to is almost irrelevant because as a company, the incremental effect is the difference between spending and earning. Remember that I said the difference was $24 million? That's almost a cash flow version of allocation because what have I done? I've taken the investment and said, given the fact that I'd have spent the money anyway for the grocery store, it's not fair punishing this project for the entire amount because that's the point you're making in a general term. Why am I punishing? I'm just going to punish it for the difference. So I'm allocating too, but I'm allocating based on the time value of money in cash flows rather than try to figure out what the revenues are for grocery stores and what the revenues are, because that is an accounting choice. It's not a cash flow effect. So the net result might be very much the same. Is you might allocate 20% of this, but from a cash flow perspective, it has no basis. It's just a made up number. Here I can say this is my cash flow effect and this is how much it's going to affect my present value. Finally, there's a 135.35 as salvage value. That sounds awfully precise, right? Is that a church bell that I see? What's a 135? How do you think I got that salvage value? It was whatever remaining book value there was in year 15. And it's the most convenient assumption you can make. And here's what. When you salvage and you get your book value back, you have no capital gains, you have no capital losses. It entirely is your cash flow. If you you could make a legitimate assumption of saying, hey, you know what, nobody's going to buy all these old restaurant fixtures from me. My salvage value is 0. I can live with that as long as you do what? You got to tie up the loose end. If your salvage value is 0 and your book value is 135, you get a tax benefit. If you show the tax benefit, I'm okay with it. You can't just say no salvage value and then ignore the tax issues, or you say salvage value is going to be higher. People will buy it for more. I can live with that too, but then you have to show capital gains taxes. Whenever you introduce an assumption in cash flows, you've got to carry it to its logical end limit. So those are my cash flows. And the side benefits, of course, are relatively simple because I kind of gave you what those side benefits were pretty directly. And you can see the margins. I looked at the after-tax operating income and took the present value using the cost to capital for the prepared foods business. That's it. Yeah. Yeah.
You don't really upgrade lost revenue from customers that can't park in their stores. You want to theoretically calculate.
If that had been an option. Here it was ruled out. Yeah.
But in this case, the case stated you lose 10% of your floor space of a grocery store, right? So that is products that can't be sold anymore.
Is that true? If you go to a grocery store, there are entire aisles that are empty. Grocery stores, if this were more, yeah, but as I said, if you want to make the assumption of lost grocery sales, I said that's fine as long as you bring in. So there'll be a third element to your cash flows, then there'll be a negative cash flow. I'm absolutely fine with that because you're thinking the right things, right? You're saying if I were really working with Whole Foods, you know what I'd have to do? I'd have to go into a Whole Foods store, look around at the layout and say, can I take what I have in the store and fit into 90% of the store? And if the answer is no, then I have to figure out how much sales will I lose if I take that 10% in the front, because it's got to be somewhere in the front to have the restaurant, so that is a prime location. How much will I lose? And that will then become part of my cash flows as well. Okay? I assume that grocery stores, because of their size, especially a typical Whole Foods store, has enough physical space that you can take the groceries and squeeze them into the remaining space. But I could be wrong. Maybe I don't know enough about the grocery business, and that could become a cost as well. Here's what you found in the net present values. Your median net present value was about 78 million, very close to my 82 million. Okay? Your high was 486 million. This was a finite life case. And your low was minus 111. There were, I think, 16 groups that had negative net present values in the finite life case. So many of you found it. And that, I assume, I haven't looked at the details, also includes the prepared food. So with the prepared foods, you were still under. Probably because if you don't bring in that positive counter to the negative investment in the parking, you will end up with a more negative net present value. So here my net present value is basically, I broke it into two parts. The dining part I discounted at the dining cost of capital. I come up with minus 108. The prepared foods part I discount at the prepared foods cost of capital. I come up with 190. Add up the two numbers. My net present value is 82. And if I want to bring in lost grocery store sales, there will be a third component, which will be negative, discounted back at a grocery cost of capital. And the composite net present value will be net present value 1, net present value 2, minus the net present value of lost grocery sales. Any questions? So now comes the perpetual life case. One of my problems with capital budgeting projects is often people do a 10-year life, they get a negative net present value and say, this isn't working, I'll just put a perpetual growth model. And if you do that, you take your 10th year's cash flows, you leave the first 10 years cash flows as is, and you replace your salvage value with the terminal value, I can safely predict that every project should go on forever, right? Because you're replacing something. So there's got to be a catch in that logic. Otherwise, why would projects even be shut down after year 5 or year 10? And the answer is, if you decide to go with a longer life, you've got to run the project right from the beginning on that expectation. It's like saying at the age of 65, I'd like to be at the perfect weight. And waiting till the day before your 65th birthday and saying, well, let's do it now. And you're 200 pounds overweight. It's not going to happen, right? So if you decide that 20 years from now you got to start to do this right from the beginning. Here's how it's going to show up. In this case, I'm going to introduce capital maintenance. And one of the problems that you ran with capital maintenance is, how do we know what a right number is? Should it be 3%? Should it be 5%? The number I look at when I look at capital maintenance is I look at the depreciation. What's one got to do with the other? What's the depreciation if you trust the accountants on their best day? They're telling you that this is how much your investment base is depleting in year 1. And if I want to preserve my investment base, what do I need to do? I need to put that money back. That's why in valuation often people bring in capex minus depreciate. They look at that offsetting effect. So initially I set capital maintenance equal to depreciation because I wanted to keep the investment base solid. But then I remembered that I was counting on inflation on my cash flows, and I said I can't count on the inflation on the good things and forget about the bad. So I set the capital maintenance at 2% above depreciation. Essentially what, if you think about it, my old stuff is depleting and I'm replacing with new stuff. It's costing me a little bit more because inflation is kicking in. So for the next 15 years you're going to see the capital maintenance kick in. And this becomes particularly critical when you get to that year 15 and you decide to put your project into forever mode. Now this is not a choice, because if you let the depreciation continue to forever and you don't have capital maintenance, you have a math problem. You know why? Because you keep depreciating, the depreciation will basically drive your asset base to zero. There'll be nothing left to depreciate. So almost by definition, when you get to the terminal year, there has to be capital. But you can't wait till you're 16 to introduce capital maintenance, because by then your restaurants look like crap. And you're now maintaining crappy restaurants at their crappy state. So you have to start to invest right from the beginning, thinking about the long term. So here's how it shows up. You see capital maintenance each year, it's set at 20% above. And here again, I decide to, because when you do capital maintenance, it's a capital expenditure, there's a depreciation that comes with it. If you add the depreciation onto your total depreciation number and you try to set, you see how the circularity will then kick in? So what I did was on that capital maintenance, I kept it separate from my regular capital expenditure. I computed the depreciation as a present value, because it's actually simple. Straight line depreciation, you just compute the 25% each year for 10 years, take the present value. So right below the capital maintenance, you see the tax benefit from capital maintenance brought in after the fact. So the big change here is I brought in capital maintenance and tax benefits into my cash flows every year. And in my terminal year, I make sure my capital maintenance is set above depreciation. So here's what's going to happen. When I introduce capital maintenance in the perpetual life case, my cash flows for the next 15 years will be lower than they were with the finite life. That's the price I'm paying for thinking about forever. But in return, what do I get? I now get a terminal value replacing my salvage value, which is much, much higher than my salvage value. And in fact, to compute my terminal value, I take the cash flows in year 16. And to compute those cash flows, I make sure the capex continues in perpetuity, 2% above the depreciation. I discount those back. But I used a perpetual growth rate set equal to the inflation rate. Was that stated in the case? I just said longer life. You could pick. You could pick no growth, you could pick inflationary growth, you could pick a growth above inflation. I chose not to pick a growth rate above inflation for a simple reason. If I set the growth rate above inflation, what do I need to do then? I need to build more stores, more restaurants. And if I have to build more restaurants, I have to have, so how much you have as capital maintenance in that year 16 will depend on how ambitious you want to get after year 15. If you want to set a 3% growth rate, I'm going to say fine. But your capital maintenance has to be much bigger. This isn't a free lunch where you play with the growth rate. I've put the inflation growth rate, but I've set capital maintenance above. So here's what the trade-off looks like. There are my finite life cash flows. There are my perpetual life cash flows. After year 0, after right now, notice that the finite life cash flows are always more positive than the perpetual life cash flows. In fact, the last column, you see how much, I'm comparing the perpetual life cash flow to the finite. So for the next 15 years with the perpetual life assumptions, I get lower cash flows because I have that capital maintenance. But then at the end of year 15, I get a terminal value which is much higher. The net effect, at least in this case, was positive. Now do you see why some projects have finite lives? Is when you bring in this effect and you look at the perpetuity, you realize that the present value you get by running this project forever is actually lower than having it as a 5-year project. And that's the way it should be. Not all projects should have perpetual lives. Some projects should be finite life, and this allows you to bring in that trade-off. So if you look at the net present value here, it is actually still negative. In fact, it's pretty close to what it was. What bails me out here is now my prepared foods business is also getting that perpetual kicker. And with that perpetual kicker, my net present value rises to $284 million. So is it possible to end up with a net present value in the perpetual life case that's lower than your finite life case? Absolutely. It's not just possible, it's probably plausible in some cases. In this case, with my assumptions, I get a slightly high, but not a huge shift. So here's my bottom line. At the end of 15 years, here are the assumptions you could have made, all of which should have been consistent with what I asked you to do. One is at the end of year 15, you can assume that there's 0 growth rate, in which case you just have a cash flow constant. And if you do that, your capital maintenance can actually be equal to depreciation because all you need to do is maintain your asset base in nominal terms. Of course, you give up that inflation rate. If you set the growth equal to inflation, then your capex has to be higher. And if your growth rate is greater than inflation, you better set aside money to build new stores or new restaurants because otherwise you will not have the capacity to get that growth rate. Your assumptions about perpetual growth will drive your assumptions about how much capital expenditure. Hold on to that thought because if any of you have the fortitude to actually come back from my valuation class next spring, this is going to be a key part of terminal values for companies, is remembering that lesson. It's a capital budgeting lesson carried into valuing companies, a lesson that people violate all the time, but a lesson worth remembering. So there's what your perpetual life net present values look like. There were about 5 of you who ended up with negative net present values with the perpetual life, which again doesn't shock me. It can happen with the assumption about capital maintenance. Incidentally, I used to capital maintenance, it's every year. You don't have to do that. You got to say every 5th year I'm going to come spruce up the stores. The capital maintenance in year 5 or 10. Any of those are okay as long as you show me that you're treating the perpetual life case and the finite life case differently. I will cut you a lot of slack on capital maintenance because in a sense you're at least thinking about the fact that you need more capital maintenance. But if you have capital maintenance in both cases, you're punishing one case or the other. So if you put in high capital maintenance in both, you'll kill the finite life case. Do you see why? Because now you're running the project for 15 years and maintaining so you've got to treat the two differently because this isn't a probabilistic choice. That's why it's not 2 scenarios. It's an operating choice and you have to behave consistently. Yes?
But it's a very aggressive. Imagine you build a restaurant in year 0, you spend 15 years with 0 investment. It's kind of aggressive.
Yeah. I think it could very well, but as long, so if you have low capital maintenance in one and high in the other, that's fine too, right? So in a sense, you could argue that this is on the razor's edge project. If I put in some capital maintenance, so as long as you differentiate between the two, I can live with any set of different assumptions. Just show me you thought through differently. It's not just putting in a G after year 15 on your cash flows. So here's what you found. Of the 55 groups that sent in, 8 said don't take the project. which I perfectly understand. This is a project on the edge, and especially you got those huge negative net present values. You might say, you know what, 43 said yes, and 4 made conditional. I hate conditional recommendations. I'm not going to knock down a grade, but things like, take the project if it has a long life and don't take the project if it has a short life, as if that were a God choice at the end of the 15th year. You decide what you're going to do. You work through the cash flows in both scenarios, but this is when you have a group with a pain in the neck in the group who no matter what conclusion you draw, but has a counter to that, finally you write this conclusion that he's willing to or she's willing to live with, which is maybe we'll do it, maybe we won't. Right? So you want to fight that because that is so, it's going to draw you. You want to be there, you're right no matter what happens, or you're wrong no matter what happens. So try to make decisions. Right? Buy or sell, no weak buy, semi-strong buy, invest or don't invest. You can't, kind of fudge your way to that answer. Any questions on it? Okay, so I will put these slides up with my Excel spreadsheet for Whole Foods Dining up on the web page, the web page for the class that has all the webcasts. I'll put that up there so you can draw it. It'll also go into the case link, so you'll be able to draw on the conclusions. So no questions? Yes.
On the maintenance capex, if you're actually in the business, if you're actually in the restaurant maintenance capex, it would practically make any difference what the maintenance capex would be if you're finite life or a long life, because what you would invest in is actually new tables.
Is it? How about the new ovens? You know how expensive ovens are? So basically it's more, yeah, so I'm talking about the big investments, right? You have to redo think of the remodeling of the
so kitchen equipment usually happens every 3 years, like $60,000.
yeah. So, but I'm saying the way you invest will be very different. So when you replace your tables, for instance, you're given two choices. Do you want to go with those expensive tables that last 50 years or the ones that are going to... So every choice you make, it's almost, you have to decide up front, am I running this for the long term? Am I going to run this to... And the difference...
It wouldn't make a difference in your maintenance capex.
It might not, but then you're going to run into trouble if you change your mind at the last moment and try to sell it for somebody else. And he comes around and says, these things look like they have to be replaced tomorrow. I'm going to pay you less. But I'm saying that you might not notice on a day-to-day basis, but it adds up. It adds up in the sense that if you spend less at some point in time, you start to notice that you've spent less. Your chairs are the Costco chairs. Right? So in a sense, the choices you made reflected the choice of how long you want to run the... Yes?
So to be clear, when we're calculating the return on capital and we're looking at the book value, are we taking into account the depreciation of the invested capital?
Mm-hmm. Book value always is net of depreciation, right? How do we compute book value? You have the starting book value. Any capex you make adds to that book value. Any depreciation you make reduces that book value. So
why is that? Because if we've already made the investment,
right.
Does it really matter if it depreciates?
Well, the minute you use book value, what are you saying? I trust my accountants, right? So if you trust your accountants up front, then you got to keep trusting them all the way through. So when they say there's depreciation, accounting depreciation is supposed to be loss of earning power, that your asset is depleted. So my point is, if you're going to go down the book value and say, I trust my accountants, you got to hang out with them for the rest of the 15 years. So when they tell you the book value went down, you can't selectively say, I trusted you when you told me how much I invested, I don't trust you now. So it's almost like a loss of capital because your assets have become less valuable. Okay? It's the fact that if you use them, they deplete in value. That's what depreciation is supposed to measure. We know accounting and economic depreciation don't match up. But there is actually an economic rationale for why an asset should lose value over time as it gets. Your car, the day you drive it off out of the new car lot, already loses 10%, and every year you drive after that, your tires get worn out. So that's what depreciation is supposed to measure. And to the degree that it measures that, you have to take out depreciation from the original invested capital. So remember last session I left you with the net present value for that online retail store for Bookscape. I ended up with a net present value of $76,375. So it looks good, right? But now I'm going to add a couple of things to this investment, and let's see if it changes whether we take the investment or not. The first is, I forgot to tell you that because this online retail store is to be run by the existing manager that you have for the bookstore, you got to pay him more. He's not going to work the extra hours, so you're going to increase his salary from 100 to 120,000 because you've added the online store, at least for the next 5 years. And if you shut the online store, or the next 4 years, if you shut the online store down, it's going to be really tough to do. So you might actually say it's 20,000 for running the online store as long as we run the store, so you're going to increase his salary. Incremental effect. The second is, it is going to use an office space that you already have, that you store records. You're going to convert that, but if you use it for this online venture, you now have to find another place to store all these records, and you're going to get a bank vault, and it's going to cost you $1,000 a year. Not big numbers, but I want you to think of the effects, the incremental effects. So I have two effects, right? The first is I have additional salary costs. Those additional salary costs have a present value of $34,532. That I actually went back and forth on what discount rate to apply on this additional salary. Do you see why? Because the guy already works for the bookstore. I actually considered using, I don't know, that risk is, but this is going to be directly linked to the online. So ultimately I decided the 18%. But if you push me really hard and say, let's go back to the 12.3%, I'll probably say, okay. It's probably not as risky as the rest of the cash flows on this. Right? The present value at 18% is $34,532. That is now a cost because it's an additional cost. If you take the office cost, the present value that I get of the office cost is about $1,600. It's the present value of the after-tax cost for the next 4 years. You bring those two costs in, the net present value is still positive, but it's less positive than it used to be. Yes?
By any chance, the salary could revert to the past? How would you treat that?
Well, so if you take with the project, without the project. With the project, you have 120, 120, 120, 120, back to 100. Without the project, you have 100, 100, 100, 100, 100. So you'd have paid him the 100 anyway, with or without the project, because you're not planning to shut the bookstore down. The incremental effect is only for the first 4 years. But as I said, it's tough to go to a guy who's been paid 120. So you'll have to make the extra 20,000, not a salary increase, but something explicitly tied to the. So when the store ends, it's not as if he's losing salary. He's not being paid for something he did extra. That's up to you as an owner to figure out how to do it. But don't give him a salary jump and go back to him at the end of year 4 and say, I'm going to cut your salary, because no matter what rationale you offer the guy, it's not going to go over well. So one way or the other, that's what I'm assuming. So I compute my cash flows and net present. Incidentally, there are two ways I could do this. One is I can take my starting net present value and take the effects. So the way I've done it is I've taken the starting net present value, and rather than go back to scratch and do everything, I've just looked at the incremental effects. One of the great things about present value is at the last moment I can throw a change in, and you don't have to do the whole thing. So let's say you get a project with net present value and say, oh my God, I forgot inventory. Can you bring it in? Part of you say, oh my God, I've got to do all the cash flows. You don't have to. You can just look at the effect of inventory in the cash flows, which is the initial investment, the change, discount it back, and that present value can be added on. That's why with the parking capacity, you can either build it into the cash flows every year, or you can take that present value, you get exactly the same answer. And just to prove it to you, I built in those opportunity costs into my cash flows, and I computed the net present value, the composite cash flows, I get exactly the same answer. And that shouldn't surprise you, because the same cash flows, same time value of money showing up. So the end result with those costs is that project looks good. Let's do a third case, and this you kind of already done on the Whole Foods case. You're saying, why don't we do this before rather than after? That's by design. In fact, if you looked ahead, you probably could have seen this kind of problem coming. You have the Vale example. You're an iron ore mine. Let's assume Vale expects to use its existing distribution system to service the production ore of the mine. So the mine manager comes in and says, look, don't charge us. You already own the distribution. There should be no cost. Okay? You're not going to be able to sell that excess capacity, so you can't count that. Okay? You can't rent it out because this is... So his point is, we've already spent the money. You're going to already be investing. Why are you charging us? And at first sight, it looks like a pretty reasonable argument. The only thing you have to stop and ask is, if I use this distribution capacity for the iron ore mine, I'm going to be using more of the capacity, and if I'm growing, I'm going to run out of capacity sooner rather than later. This is exactly the parking. Is often companies, when they look at a lot of excess capacity now, say, that's free, let's take a project. You have a big server's being underutilized, let's use some of that server to process data. Okay, great. It's your job and my job to think through the consequences of what it means down the road. And that's basically what we're trying to build in. Yep.
In the extreme example,
Yep.
say, I don't know, uranium mining or something where you know there is not other uses.
Then there could be zero opportunity cost. If you have in fact, it doesn't even have to be extreme. Let's suppose Vale is now a low growth or a no growth company. Their distribution capacity is going to have excess capacity from now through eternity. You can look at the future and come back to me and say, you know what? I can use up this excess capacity. It's going to cost you nothing because you have no growth. So that's always on the table, but only after you've checked through the alternatives. Okay? So when you think about assessing excess capacity in general, it can be excess capacity distribution, parking, computer service. Here are the questions you ask. What will happen to that capacity if I don't take the project? What will happen if I take the project? That's always the starting point. And then you got to ask a third question. When I run out of capacity, what do I plan to do? And what can you do? As you said with the parking, when you run out of capacity, you can say, I'm not going to build additional capacity. It's too expensive. I don't want that real estate investment. I'm just going to turn shoppers away. In which case, you have lost sales and cash flows and those lost sales, and you compute those present values. Or you can say, look, if I run out of capacity, this is not a choice. I'm going to build more parking, in which case it's investing earlier rather than later. So in the case of the parking, that's why I constrained you, because I could have left that unclear, and then you'd have had to deal with it. In year 6, what do we do? And which is the better thing to do? Build more capacity or turn away shoppers? It depends on your business, right? If you're a business where your margins are, really, really thin and the business is turning bad, you might say, you know what, this is not such a great business anyway. These customers are not making me much money. Let them go. Let them go to Kroger's. Maybe they can bankrupt them first. It depends on the business. That's why in a real choice, you have to work through both consequences and decide which one works for you. One final example. The Rio Disney. I said one of the potential costs is some of the people, in fact a fairly large percentage of the people, in this case let's make it 20% of the people coming into that theme park would have come to Rio or to a Disney theme park anyway, to Orlando, to Anaheim. So all you're doing is you're taking them from one theme park to another. So I'll give you the extreme argument you can make. They're not incremental. So when I do my revenues for the Rio Disney theme park, I'm going to count only the 80% that are new visitors. The remaining 20% would have been revenues that I've collected already. And let's work through. If you do that, then you're going to have lower revenues, lower cash flows, and you probably, in this case, reject the theme park. Or you can say, I'm going to count all the revenue and come up with a net present value. Which one should I do? I mean, can you imagine for Starbucks, being how many Starbucks are there within shouting distance of this building? Whispering distance, actually. Shouting distance would be like 5,000 of them. They're like 6. Can you imagine being the capital budgeting analyst for the Starbucks that opened on Broadway when you had 2 others here? Who's coming to that? Not all new customers. It's probably somebody who's so lazy. I had to walk 3 blocks. That was so long. Now it's 1 block away. This is not a small issue, right? Because often when, especially in retailing, and you build new stores, you're drawing people who used to go some of the other stores. And this is a big decision to make. Should I count all of the people coming in as revenues or only the incremental people? What do you think should drive the choice? Yeah. And maybe they buy less food in Rio than they do. Do you know that in Shanghai, one of the problems that Disney is having is Chinese visitors seem to pack their food and come in. Right? You go to Anaheim, they're feeding you all day long with overpriced crap. Well, Chinese customers are too smart for that. They say, I'm not buying overpriced crap. I'm going to bring my lo mein in. I guess they don't do the checking as carefully. So it might be that in Rio people buy less food. So in which case, that's an incremental effect you should build in. But let's carry this its logical limit. let's suppose that Starbucks decides to count only incremental customers. There's no way you can justify the opening as many Starbucks, so you build fewer Starbucks. It's good, right? Because that's good. What's your nightmare scenario? Why would that guy come to the broad? Because he was too lazy to walk 3 blocks. He wants 1 block away. This guy's lazy. That's his first characteristic, most important characteristic. Your worry is that Aubampan or somebody else will come in and open 1 block away, and this guy says, I like Starbucks coffee, but it's 3 blocks. You know, the cappuccino here is not as good, but it's only 1 block away. You know what you worry about is that 20% now will now go to it's better to cannibalize your own sales than to have somebody else cannibalize your sales. So here's my dividing line. If your competitive advantages are so strong that these people will come only to you. Like in the case of Disney, it's not like you can tell your kid, we're going to go to a Disney theme park, and then pull a bait and switch and say, hey, this amusement park looks like somebody that looks like Mickey Mouse over there. It doesn't work. It's not an easy substitution. So when your comparative barriers to entry are strong, you will count only the incremental sales. But when your comparative barriers are weaker, you will count the total sales because you're afraid that if you count the incremental sales, turn away projects. So the way Disney looks at this will be different in theme parks, where its comparative barriers to entry are much stronger than the broadcasting business. So if you're producing a TV show, you can't say, well, you know what, 30% of my customers, those kids, are just watching one of my other shows. I'm pulling them away from my other shows, so I'm not going to produce the show. You're asking for trouble. So the stronger the barriers to entry, the more you look at just the incremental stuff. The weaker they become. It's actually a huge problem in the pharmaceutical business for customers, right? Let's say you own the dominant ulcer drug in the market. You have 15 years left on your patent. And your R&D department has come up with a significantly better ulcer drug. Do you see how tricky this becomes? Because you own the market. You have 80% of the market buying a drug. The competitive barriers to entry are huge because, it's not... So if you bring out this better drug, you actually are going to get a lot of your sales coming from your own customers. My guess is you're going to wait until you have fewer years left in the patent, which is terrible news for you if you have whatever the disease is. But you can see why when you have barriers to entry that you're going to get much more delay in this process in introducing products that cannibalize your own sales. Yes?
But then what if the other stores are now losing money and actually have to shut them down?
Well, when you mean that once you do this with 100% and you start adding up, it's exactly what happened to Starbucks in 2007. Okay? And at that point, they actually had to start shutting them down. It is actually a consequence of very competitive spaces. You will get, this is a feature, not a bug. You're going to see this happen with retailing simply because you can't afford to count just your incremental customers, but you can't afford to count all of your customers. You hope there's some steady state down the road where it works out to. But it's a very real concern, and I can't give you an answer to that. It's the same reason I can't answer the question, how do I stop bad R&D? Because by the time you've done the R&D, it's a sunk cost, right? So when I do things right and look at only the incremental cash flows, I'm doing things right, but you still have a fundamental problem. You have an R&D cost that you've got to cover over time. So that's what makes it messy, because you're saying, well, therefore I'm going to open fewer stores. There's a danger with that as well, because you might then end up losing sales to your customers, your best customers, and your existing stores, which you thought were cash cows, might start suffering. Yeah. So I can't give you an easy answer. Maybe there's a way you can find, or maybe you can create barriers to entry. Maybe that's the answer, is create enough barriers to entry where this is not happening to you. Maybe that's the ultimate answer. Yeah. Let's talk about synergies. In that Tata Motors Harman case, we didn't have it. But let's face it, when Disney makes big decisions. So have you got the emails yet for the Avengers Get advanced ticket sales? I've got like 6 already. I'm an AMC monthly pass member. They said reserve your ticket. So but let's face it, as I said, when you think about projects at Disney, they're almost never contained. Everything has side benefits. So when you think about synergies, the question is not whether they exist, but how to incorporate them in your analysis. Okay? So let's take that bookstore that we did. Remember, the net present value is already positive. Okay? Let's assume that this case, if you have that bookstore, you add a cafe to the bookstore. Okay? The cafe to the bookstore has a net, if you take the net present value of a standalone, let's say it has a net present value that's negative. So by itself, as a cafe, so think of it like the restaurant at the Whole Foods. By itself, the restaurant might have a negative net present value. But let's assume that by having this cafe, your people who come in who never plan to buy books. And this actually, if you go into the old Barnes & Noble, they'd put the cafe right next to the magazine section. Next thing you're walking out with 4 magazines you don't want to read anyway, but you feel guilty because you sat at the table. So you get additional sales. So if you think about the synergy here, it comes from additional sales. The additional sales get cash flows. So when you have synergies that are that easy to compute, you're going to bring them into the analysis by just taking the present value. In this case, it doesn't change your decision. It still is going to, if you look at, it does change the decision because the net present value of the added sales is greater than the negative net present value added for a standalone investment. And this is actually, I almost considered giving you a different case. And my case was going to be Cinemark. Because as you know, AMC's monthly pass has been incredibly successful in terms of getting, it's $25 a month, it's like 3 million subscribers. And every other theater company is saying, should we do that? I almost thought about doing it around Cinemark, introducing a monthly pass. Because that monthly pass has classic side costs and side benefits, right? The side benefits are going to be that you're going to get people coming in 3 times a week or 4 times a week when they'd have come only 1. And not only, you might not get additional incremental revenue from them coming in, but they buy food and popcorn and stuff. So that might be the cost is the kinds of people who will get the monthly pass might be the people who are your most lucrative customers. So the side cost might be you're actually getting less per customer when you look at those customers. Side costs, side benefits. That analysis would have been all about the side costs and side benefits. You know that Lyft actually considered introducing a subscriber model. They tried it, and they very quickly gave up. And there's a simple reason. 10% of ride-sharing riders account for 90% of the revenues. It's a 10-90 business. So I don't know what it was, San Jose, maybe they tried to introduce. And what they discovered, that their 10% who used to give them the 90% all bought the subscription model. They paid much less in subscription than they'd have collected. So if you're thinking about subscription models, they work best if you have fairly even revenues. They tend to break down when your revenues have that 1090 feature. Movies don't usually have as much of the feature. There's still their avid moviegoers and lesser ones. But that's what you think about as Cinemark is, do I have 20% of my customers accounting for 90%? Because then you're going to have a problem with the subscription model. And of course, you have crazies like MoviePass competing with you, so God help you in terms of pricing against them. But hopefully that insanity is getting to an end. So finally, let me go back to the Harman acquisition. Remember that the value that we got was, I think, what, $2.476 billion. Okay. The stock price was already $5,248 million. So if you're going to acquire this company, obviously you've got to pay $5,248 million plus. But you say there's lots of synergy. So let me list out some of the potential synergies. Let's assume that by acquiring Harman, okay, you say it'll take about 3 years for Tata Motors to put their audios into Tata Motors cars, but because they've got much better audio, and this is a kind of a stretch, let's assume that they can sell more cars, that they'll generate 10 billion rupees more in additional after-tax operating income with the better audio put in. It's a synergy, right? That synergy is going to show up after year 4, and let's see how we value the synergy. The business risk here is because this audio is going to Tata cars, I'm going to revert back to an automobile beta. Because people are not buying the audio, they're buying the car with the audio. And that's a judgment call. You can say, well, maybe they're buying the audio and then the car is a throw-in. I don't know how many people are so fixated on their stereo in the car, but I don't think it's going to be the driving force. For geographic risk, I'm going to revert back to India. Why? Because it's, in my story at least, it's not the Jaguar Land Rover cars that are being retrofitted. It's going to be the Tata cars in India. And finally, for the debt ratio, I use Tata Motors debt ratio because it's the automobile business. So with those changes put in and computing everything in rupee terms, my cost of capital in rupees for this slice of cash flows is 13.63%. So at this stage, you can already see cost of capital is a malleable instrument. Depending on what you're discounting, you can have costs of capital that vary within the same company or even within the same investment analysis. So I took my synergy and I kept things simple. I assumed it was a perpetuity growing at 4% a year. And remember, because it's Indian rupees, I can get away with a much higher growth rate forever. The present value that I got was about 103 billion. And that's assuming you start in year 4. I brought that present value back to today because I've got to wait 3 years to incorporate these benefits. The value that I got was 70.75. And if I converted that at the exchange rate on the day that I did this analysis, which is 60 rupees to the dollar, the value of synergy is 1,179 million. Synergy is nice. It has value, but it doesn't get me as far as I need to get for this acquisition to make sense. Because you add the 1,179 to the value that you got for the company, it's still way below the 5,248. And remember, to acquire the company, you got to pay 5,248 plus a premium. So synergy can be brought in, and you can still conclude the acquisition doesn't make sense. It's not going to just fill in whatever the difference is between what you pay for something and what you value that. So the next big merger that you read about in the paper rises the challenge, because they'll talk about synergies. See if you can think about the synergies. See if you can think about how you would value those synergies. In some cases, it'll be easier than others. But if it's economies of scale, it's usually cost cutting, higher margins, because that's your job to make sure that you're not overpaying for the synergies. Any questions? I'm going to close this first packet by talking about something that really has been under the surface so far. When you do a net present value of a project, what do? You stand as of today, take what you know today, and based on what you know, you project the cash flows for the future, and you do the best you can with what you know today. You come up with a net present value that is negative. What do we say you should do? Don't take the project. I'm now going to break my own rules. Because when you say a project is a negative net present value, you then say it's a bad project, right? I'm going to argue that sometimes a bad project can still have value to you. Here's the first scenario. Can a project that's bad today become good in the future? Yeah, technologies can change, markets can change. The rights to a bad project, it's going to sound completely absurd, the rights to a bad project can still be valuable. The rights to a non-viable technology can still be worth billions, because there's an option to delay as long as you have the exclusive right to take the project. So we're going to talk about the option to delay. The second is, sometimes a bad project can give you entry into a really big market. It will allow you to make other investments in the future. So let's say you're a company looking at China. Let's pick a nice big market. You're a hotel company. You look at opening hotels, and the net present value of your analysis is negative. You say, no, let's not take this. But then you say, remember, the net present value is an expected value. There are outcomes that could be positive. If you take this project and the good outcomes come through, then maybe this will allow you to take an extra project, a second project, which could have a huge positive. It's called the option to expand. It's the option that people get most excited about, because it allows you to do really bad investments and get away with saying there's an option to expand. And then there's an option to abandon. Take the Whole Foods case. Wasn't a big deal, but let's suppose it was a huge investment. And let's assume 3 years in, you're looking at your revenues and cash flows, and they're running way below what you thought they would. It wasn't that you didn't do your homework. People don't want to go to a restaurant in a grocery store. Are you stuck for the next 12 years? You have a 50. Not necessarily, right? You might be able to get out of some investments, called the option to abandon. The more of a choice you have to get out, the greater the value for your project, because it means you have an option to escape in case you're wrong. The option to delay, the option to expand. What they share in common is when you bring those options in, a bad project can start to become a project that you want to either pay for or actually take today, because those options overcome your negative net present value. Now, I'm not going to hit you with deep option pricing, but I'm at least going to set up the process. Let's take the option to delay. First, remember what makes options options? It's that payoff diagram, right? Because if you cut to the chase, it's a payoff diagram that gives away an option. And what's unique about an option payoff diagram is there's a kink around the strike price. If your underlying asset is worth less than the strike price, if it's a call option, the most you can lose is what you paid for the option. But if good things happen, you get that positive upside, limited losses. So when we talk about the option to delay, here's what we're talking about. there's an initial investment in the project, that's like the strike price. Today, the present value of the cash flows are less than the investments, so the net present value is negative. So there, you're sitting right there. But as you have the rights to this project, you revisit this project a year from now, 2 years from now, who knows, markets could change, technologies could change. The present value of your cash flows that right now are on the negative side could go to the positive side. Your net present values could turn positive, and you might take the project. It's an option today. What does it mean? You will pay for the rights to a bad project today, and then you'll wait and hope it turns good. Could your hopes be dashed? Yeah, absolutely. In which case, what do you say? I wish I hadn't done that, but you did your homework. This is what you get when you buy a patent, when you buy a license. You get the right to do something. I think it was Google that bought, I think, a whole stack of patents from Qualcomm, hundreds and hundreds of options. 95% are probably worthless. They got thrown away. But the 5% that pay off, you hope pay off enough that they cover the remaining 95%. The option to delay is a great way of explaining, why having the exclusive rights to a technology can be worth a lot even if that technology is not viable. Why having the exclusive rights to produce a drug is valuable even though that drug might not be quite working or you haven't got it right yet. And they're more valuable in businesses where there's a lot of uncertainty than they are in businesses where things are pretty much known. Do you see why? This comes from the optionality. Options are the only assets whose value goes up as risk goes up. Why is that? Intuitively. I mean, when we talk about stocks, we talk about projects. When we increase the risk, the discount rate went up, the value went down, right? Why, when it comes to options, do we throw those rules out of the window and say, higher risk, higher variance, higher value? What is it about options that does it?
Because volatility means there's uncertainty, and options give you the right to bring a certain level of certainty into it. Like, I can exit if I want.
Well, I think you have two things. There's volatility, but there's volatility everywhere, right? But in regular assets, they hurt you. Yeah. Exactly. Which risk do you worry about more? How many of you worry about upside risk? You're worrying, oh my God, my stock went up 80%. I'm feeling terrified. Downside risk is what we worry about, right? When we take regular assets, you got upside and downside risk, and therefore risk is not your ally. It's something you factor in, and you... What did I show you with the payoff diagram for an option? What happens? What did I do with your downside risk? I floored it. You can't lose more than what you originally paid for the patent or the license. That is a huge plus now, because all you get from variance is the upside, which effectively means if I sell you a bad technology in a really risky business, you should get really excited. This is amazing. Bad technology in a really risky business, I actually pay more because I know less about. It's one of the few cases where the more ignorant you are about the future, the more you should be willing to pay. Because uncertainty and unknown is what's driving the value of the option. The option to expand. When we do the valuation class, I actually will bring option pricing, and I'll bring this into company valuation. But let's get to the intuition. The option to expand basically is you have a bad project today, but you're willing to live it. Why? Because it gives you the right to take a second project. Suppose Marriott is thinking about going to China. 100 hotels, and it does the net present value. The net present value is negative on the 100 hotels. But as part of the deal, if they open the 100 hotels, they'll be given the exclusive right to open another 1,000 hotels there. Right now, you're saying, I probably won't do it. But here's why you might tilt the decision. On the 100 hotels, you open them. Let's suppose you start to do really well. You say, this is working much better than I expected. You now have the right to open another 1,000 hotels. That could be worth a huge amount. That second investment tilts the choice in the first one. You're willing to take the negative. It also means that companies, when they go into big businesses, artificial intelligence, fintech, if you look at the net present values of the actual investments they're making, they're actually going to be negative, but they're willing to live with it because they get that option to expand. And it's kind of scary, because it means you... So here's the question I always have for companies when they use this justification. Usually they won't even use the word option. This is what strategic means. This is really what strategic in its best level means is, this project is a bad project, but there are strategic considerations. What you're saying is China is such a big market, we can't afford to be out of it. This first project gives an entree. And the question I always have is, by taking this first project, are you getting any exclusivity? Is there, because I know China is a big project, but Marriott opens these 100 hotels and it has no exclusivity, no second license. Here's what will happen. Marriott's watching its hotels to see how well they do. Who else is watching the hotels? Unfortunately, I think Marriott owns pretty much everybody now. Because I noticed my Marriott app keeps ringing in. Oh, now you're Starwoods. Now you're the Ritz. But let's say that this was when Starwood was a separate company. Starwood was watching the same hotels. And if Marriott hotels do well, just as Marriott gets ready to open hotels in the rest of China, guess what Starwoods does? It opens. You need some exclusivity for options. And that's where many of these strategic, big market stories break down, is you have no exclusivity. Let me close with one final thing, is if you make a mistake, it's always nice to be able to walk away from your mistakes, both in personal life and in business. Okay? It's good to have an escape hatch. So when you know you have an escape hatch, it makes you more willing to take risks, to take projects. And that's true in investment analysis as well. I'm always staggered when companies say, well, I'm not going to build escape hatches because it's a sign of weakness. I want to show how convinced I am about the quality of the project. No, options to abandon are useful. It's the only option that's a put option. Most of the options we talk about, this is what falls in the rubric of real options. Most options are call options. The option to abandon is a put option. So we're not going to do options in detail. You don't have to know, you do know there's a quiz coming a week from today, right? So you get an email about that. You don't have to remember Black-Scholes, binomial. I will not quiz you on options, but intuitively I want you to think about why options can change decision making. And later on, when we bring in option technology, maybe we can start to get more tangible with this argument. Remember to print off your second packet for next session, because we're done with packet 1 pretty much, so print in or buy packet 2. No. I don't know, I'll have to check. They're not really good about carrying stuff, so I'll check with them.
Grossly overstated. If I do the correction, they're all within reason. But I'm gonna have to change all like the report. So I can change. I'm happy to do it.
Just send me a note that that's what you did. So when I look at yours, I'll probably catch it, but just keep me on.
Okay, I'll send you an email.
Yes.
Hi, how are you? Hi, yeah.
See, unfortunately, I can't do quizzes early or late because I can take the 10% and move it to your third quiz in the time. That's always the option. I think that's a more viable option than trying to move the quiz because it's too messy of a class to decide. I have to write a fresh quiz. So if you can move the 10% of it, maybe it doesn't hurt you. It just means the third quiz and final will be worth it. Sorry.
Yes.
Eventually. This has happened after I did this. Originally, Harman was going to go into private equity deal. KKR and Goldman. That private deal fell apart because it happened around 2008. So that deal fell apart, and other companies were interested. Eventually, Samsung did acquire Harman. Well, I mean, it's the same kind of rationale. Samsung wanted them because both their patents in the audio space and their brand name, because it's such a well-recognized brand name. I'm not sure they've done much with them, to be quite honest, because the business has changed so much. It shifted away from stereos to portable devices. It shifted away from having great speakers to having great headphones. And unfortunately, Harman's headphones were never there. So the Beats and the headphone companies in a sense have become more valuable than the speaker companies. Bose's most valuable products are its headphones. It's not the speakers. So, yeah. But I don't know.